Hi, Alex. Thank you so much for coming to Investor Talk. How are you today?
Good. And Max, thank you so much for having me on. I really appreciate the opportunity. I'm happy to share whatever insights I can, and hopefully it's valuable. But yeah, doing well and happy to be here.
Thank you for your time. Uh, Before we jump into the main topics we'll be covering today, would you like to give an introduction, short intro to yourself?
Sure. There's a lot of different things, but I'll give you kind of the overall like high level introduction. So my name is Alex Felman. I like to call myself a entrepreneurial professional because I wear almost every hat in the ecosystem. For this conversation, the more important one is I'm the general partner of my own family's family office. On that side, we do something which is quite unique in the sense of my family has our own individual family office, as well as we have a multi-family advisory group where we work with about 50, 60 families globally. It's a bit unique because almost every family we work with is still an active operator or business owner in the various industries they work in. So with that in mind, we actually operate a lot more like a corporate venture capital than we do kind of a traditional family office or VC investor. And with that in mind, we really look for strategic investments in the industries that the family businesses are in. So it's a lot more like a corporate. I think that's one thing to emphasize. But interestingly enough, my family's been doing this for, I think it's almost 25 years now. I got involved in 2014, so almost 10 years now. And kind of interestingly enough, and where I sit, my background's actually in biochemistry and the commercialization of science. And because of that, I lead up what I like to call our futuristic deep tech investments, and that includes anything from biotech, healthcare, life science, to food and ag tech, to cybersecurity, to clean tech and gaming infrastructure. The other thing is, as you may or may not be able to tell, I'm an American that happens to be living in Latvia. Our headquarters is in New York City, which is where I'm from originally, but I also lead up our European office. So I'm kind of the head of the European office, so do a lot of the sourcing and deal flow for Europe, as well as essentially, be the boots on the ground and the face of the family in Europe. So I'm the one who's going around the continent and going to different events and letting people know who we are and what we do and that for that. It's not as relevant, but I'll just touch on some of the other stuff I'm doing. I'm also an entrepreneur, so I'm building a company right now, a bit of a Wix for content creation is the short version of that, as well as I do a lot of what I like to call community activities, to a certain extent, things like this, where I like to give back. And that's a mix of public speaking, workshops, mentorship, working with accelerators, et cetera. A lot of ways I like to say is a bit of the pay it forward, which is I think a big, as an American and a big Silicon Valley mindset is to pay it forward, as well as kind of before I got into this space, I was in education for a while and a teacher and doing that all over the world. So I think it's, let's say how I exercise those teaching muscles is through the community activities that I do. So.
That's a massive background. You've
Yes.
done quite a lot in your life already. It helps a lot. Let me ask you, in which sector, stage, geography with your family you prefer to invest in?
So as I kind of mentioned, my personal focus is in those five main areas, which is biotech, healthcare, life science, food and ag tech, cybersecurity, clean tech, and gaming infrastructure. Usually, at least let's say where I'm personally focused is more A to C rounds, primarily direct investments, but also into funds. That being said, we do go all the way through essentially to exit, whether or not that's IPO, buyout, sometimes even because we actually have businesses in these areas, we might be the exits ourselves. So it becomes almost like an M&A deal. Within that, actually, with the families we work with, even though my family is an American family, about 80% of the families we work with are non-US based, roughly equally distributed between Latin America, Europe, Middle East, and Eastern Asia. And so we don't really have a geographic focus. We're really trying to source the best deals that we can find. We don't really care where they're from. One speciality of ours actually is what I like to call cross-regional, where we really kind of help families find opportunities in regions that they're not. So let's say bring a European company to Eastern Asia, to the US, to Latin America, vice versa, et cetera. That's kind of a speciality of ours. But yeah, I think that touched. Yeah, I think I hit on all three, but that's kind of our kind of mandates.
In terms of ticket, How much to invest normally?
It's usually essentially, I would say, if we're talking into startups, I would say it's 2 to 3 million plus. So, and we go higher. Into funds, it's probably about 5 million plus. Like I said before, I'm looking at kind of up to C, but we do growth and all the way through. So that's kind of what I'm really looking for. With the way that we look at things is, I know I'm using A round, which is kind of more standardized terms. But for us, it's a little bit more because we're similar to like a corporate investor. We're really, really looking more about company maturity. The round is more of a proxy for company maturity, but it's the type of thing that with most of the investments that we make, we have organizations that actually want to integrate those products or solutions into their organizations in some way, shape, or form. And so we're really trying to make sure that the companies that we invest into would be ready to integrate into some other larger organization from day one. And so because essentially, us and our businesses and kind of through our group, if we are making these types of investments, we don't want it to be a risk that, we plug it into these core businesses and it starts to screw things up, right? And we need to kind of de-risk it from that perspective. And so a lot of the perspective of the risk that we help fund is essentially scaling risk. And in general, often the deals that we put together are kind of, for lack of a better term, I'll call them investment plus, because usually kind of an investment with at least the idea that we're going to put some kind of other business development type deal together with some of the organizations that we're working with. They'd kind of go hand in hand. And that might be kind of, we might become customers, distribution partners. We might help do cross-regional. We might help do pilots. And to a certain extent, if we don't really see that, let's say, the possibility of doing some of those things, I would say it significantly actually decreases the possibility of a deal going through. It's we kind of need to see that there is the possibility of, what's often called value add, that there is the possibility of doing these value add activities. Otherwise, we sort of, why are we going to put our weight behind it if we can't also put our other resources behind it?
Yeah. Which are the top concern? What you look the most when investing? Because you are not that early. You working in AB. It's already not mature enough, but it's already a mature stage with revenues. What you look at the most?
I would say I'm always, let's say when I review a pitch deck, the thing that I'm always thinking about is, and this I think comes from my science background, is what is the hypothesis of this company? And I kind of use that as a proxy for what is the way that the company thinks, and how do they analyze information? Because ultimately, and I think even with every company, and yes, let's say we're slightly later stage than some people, we're still fairly early in the general company life cycle. The companies are still going to change a lot. So you really have to kind of understand, what is the thought process of the founders? How are they going to deal with the problems that come up? And I think when you see, let's say, pitch decks or presentations, what I really want to try to understand is essentially how do these people think about the world? How do they think about problem solving, etc. And if I start to find flaws in kind of those types of things, that's where it starts to become red flags for me, because ultimately I feel like that shows that they're likely going to make a mistake somewhere. I don't know where, I don't know when, but it's kind of this is where they're likely to break, so to speak. I don't know how much I like to. I don't know if you've read, like, let's say, Anti-Fragile, but they talk about, everything breaks upon its weakest point. And so if I really sort of understand, like, okay, this is their thinking, these is where the thinking doesn't quite add up, I kind of know at some point that's where the cracks are going to form, and cracks just grow over time. And basically at some point cracks become large enough that they're fatal. And so that's what I really try to send is, how are the founders thinking about it? Do they have, let's say, a process in place to learn more and improve, and just those types of things. And again, I think it's real proxy for, in general, if you're building a company, almost everything you do is quite complex. In general, I've gotten to a point where I believe it's more complex than you can actually understand. And so you have to sort of, what is this person's or team's ability to deal with uncertainty, and dealing with a world where they don't understand everything, and how do they approach that? And yeah, I think it's kind of really, I almost find it funny, but it's, if you understand the statistics, it's not that unsurprising that a lot of companies fail at the really, really basics of this, of things as simple as like, they don't understand who their customers are. They don't understand their own business, like their own business models. They don't understand like, in general, my expectation is if you're a founder of a company, you should probably be the number one expert on whatever it is you're doing. No one should know more about your business than you, right? You should have the, let's say, as full a picture as anybody that exists in the world. 2 minutes, 3 minutes, 5 minutes, whatever amount of time that I spend on a pitch deck, that's like, this seems like you're missing some really big things. Like I can see it just from a really quick glance. Then it shows me just I don't know, your thought process on this is not where it needs to be for this to be successful. And that's kind of how I think about this. And so I think that's what's really important is can you show that you're kind of clearly the expert about this, not just, let's say, the problem you're trying to solve, which I think is really important, but also your own business. Do you really understand what you're doing? And also, can you communicate that? Because I think that's also another thing, right? Is I think a lot of people have trouble, maybe they are the experts at their own business, but they also have trouble communicating that to other people. And if you can't communicate it, then I also don't know what that is. And I think, a lot of people will say, right, the way that you communicate can often be kind of a window into how you think and the way your thoughts are structured.
Indeed. Fully agree. How important is for you face-to-face? Can you go all the way online up to investing without never meeting in person a founder?
I would say I think we can, but I think it's relatively rare. And I think one of the things that, let's say, as a group, with the way I am now, it's a little bit different, but let's say as a group, because at some point it's going to kind of run through the group, we're relatively lucky in the sense of, we're headquartered in New York City. Most people, let's say within a fundraising timeframe, will probably come to New York City, right? And so usually, but seriously, right? It's most people at some point, let's say for most fundraising, I usually, when I talk to startups about this, usually I would say most fundraising takes anywhere from 6 months to 18 months, right? And I would say realistically, assuming you're fundraising, and it might depend on exactly what geography you're in, but assuming you're fundraising, a trip to New York will probably make sense at some point in a 6 to 18 month time period, which means that we probably get the opportunity to meet almost everybody that we would consider investing into. Not to say that we wouldn't, but we would like to, and usually there often becomes an excuse. And I think you could probably say that for most major financial markets, London, Hong Kong, etc. Being in Riga, that's a little bit different. But that being said, I'm pretty active around Europe for my sourcing. So there's usually a number of opportunities throughout the year, throughout a fundraising cycle to run into people at various, events or conferences or whatever. And I think, let's say our preference would be to meet someone. And I think, again, I think that ties to the last point, right? Is to really try to understand and to really see that, let's say, if the person you see on paper is the actual person in front of you, that's kind of what you're trying to analyze. And not to say we haven't done it, but I do think that at least for, let's say, completely new deals, that we would want to probably meet that person at some point in the process. And usually, I would say, especially the main headquarters, usually, we happen to be in a good city, so that usually works itself out.
Let me ask you, how involved do you get with your portfolio? How do you help them to succeed?
Yeah, I mean, I mentioned this a little bit earlier, but we get fairly actively involved, and as I would say, unless we can become what is typically called value-add investors, we actually won't make the investment. And I think that, actually being said, something that I didn't mention before, but another, let's say, aspect of this is that one thing we will find, because usually we like to take what I like to call significant minority stakes. So it's enough of a minority stake that we can actually have some sway within the company. And if we find, for example, that for whatever reason, let's say the founders are, let's say, not a good personality match to what we do, and we feel like we're not going to really be able to get kind of the sway that we would like, then we're probably not going to make the investment. And part of the reason is that, like something I said earlier, is that we're probably going to try to add other types of business growth deals with the investment that we do. And like I said before, that could be things like distribution deals, cross-regional deals, pilots becoming customers, maybe some other strategic partnerships, whatever that may be. But we're going to try to add something like that to the table. And yeah, if we don't feel like we can do something like that, like even though let's say we have the resources to do something like that, let's say it's a food tech company, or let's say an ag tech company. Like we work with a number of, like some of our families are agricultural families. We might want to deploy their startup solution to our farms. If the startup is like giving us pushback about doing that, then from our perspective, like what are we doing here? If you're not able to sort of deliver to our own farms, we're kind of almost handing you customers on a silver platter, and you're kind of saying, oh no, then like why would we be an investor in this? So we do a lot of that. I mean, I think also as well, we have our own family office money, but we also have probably a much larger investor network, etc. We have a good relationships across the board. We would probably help do that as well. And I would say also as well, in general, just with our strategy, we tend to be buy till exit. And so we are probably, if we're going to get in, and assuming that like nothing goes terribly wrong, we're probably going to be follow on investors in as many rounds as we can with the business. And so that's sort of another thing as well, is we're going to want to continue to have skin in the game. And again, part of the reason that's the case, right, is the investments that we're making are highly strategic to companies that the families and our own money owns. So there's really good synergy. I think a potentially good parallel to something like this, and a good example. I don't know if you've been following the whole thing, right? But if you look at what's been happening with OpenAI and Microsoft, I think that's a fairly good parallel. Recently they had just invested a whole bunch of money, but if you actually look deeper in the history of it, the parallels and the relationship between OpenAI and Microsoft has been going on for a number of years now. They had an earlier deal, which I'm going to be missing some of the exact details, but the short version is Microsoft put in some money in exchange for allowing them to use Azure's cloud computing for their AI systems. And so they had this sort of symbiotic relationship that just was further reinforced by the recent investment by Microsoft. And so they've been building this relationship over time. So it's, when you actually look at this, it's actually not that surprising that once ChatGPT got released, Microsoft put in even more money, and they wanted to continue to do that. And they just put it into Bing, and that I think is a really good example of the type of stuff that we might consider doing for the appropriate startups.
Let me ask you. I've been talking to quite a few corporate venture capitalists, and they like in their portfolio, their companies having some kind of interaction between them. Is something that applies to you?
You're saying like, let's say, exploring synergies between companies that we've invested into?
Correct.
Sure. Yeah. I mean, from our point of view, like, why wouldn't you do something like that? If you can see that your portfolios have synergies with each other, then why not try to find ways to bring those companies together, leverage them, try to generate value? From our point of view, that would help you de-risk the investment. Realistically, honestly, any form of value creation that you can put together, we would try to do. And again, like kind of echoing what I was saying before, that might be with our own parent companies, that might be with the companies that we invest into, that might be with external companies that we're friends with, part of our network, etc. We're kind of always looking for ways that we can do that, where we can kind of de-risk, where we can add value, where we see all of these as different ways to kind of ensure and increase the probability of success for the companies themselves, and then thus our investments.
I mean, what can be your suggestion to founders when, as you said before, they must change? It's very rare that you start with a business and you keep going for all the rest of your life. Time to pivot will come one day. What's your suggestion to founders? How to detecting that actually it's time to change, it's time to pivot? Otherwise you will fail.
I mean, I think it's one of those things that's kind of always a challenge. But I think I think we have to back up a little bit and really go, okay, if you have a founding team, I would argue the way that you should be operating is you should be running lots of experiments and testing things. And so if you're kind of in a mindset of we're testing out things all the time and we're getting back data and we're, finding out new things about the world and about, our industry and the problem we're solving and et cetera. Essentially, if you get to a situation where you run these experiments and you kind of go, oh, we think, we believe these things, that thing, whatever, and we run an experiment to test it, and those experiments come back negative, then that should probably be an indicator that like, something about the way you think is off, and that you need to either go back to the drawing board. There's a question of how much is that a pivot or a micro pivot or a fine tuning or whatever. I think that it's hard to say on the exact situation. One thing that I think is super helpful is that I think a lot of founders get very married to their ideas because I think they believe that the ideas is kind of the most important thing. And I would argue, and I actually give a talk around this, that like, yes, an idea is something that you need, like it is somewhat of a prerequisite. But it's almost like one leg of a table. Like by itself, it doesn't do so much, but you need the other legs of a table. And everything goes together to make the table itself. That's the sales, the marketing, the actual building and execution, and all these things come together to build an actual table. And you can think of your startup like a table. And I think if you become married to your idea, then you become, let's say, much more beholden to the sunk cost fallacy. You become much less likely to pivot when you need to. And so I think if you're able to be very, let's say, disciplined about making these types of experimental loops in how you run things and try to be somewhat objective about them, I think that can help guard yourself in becoming kind of too emotionally invested about an idea. And I think that's kind of one of the biggest things is if you stop being emotionally invested and you kind of think about it more about, all right, we're going to build this process to solve this problem or to help other people. And it's more about the process of helping people than like thinking that my way of helping people is the best way to help people. I think that really helps. And I think with that as well, right, is if you make yourself kind of customer centric, I think that will help you in being open to pivoting, because it will help you kind of remind yourself at the end of the day, if your customers are telling you that what you have is not what they want, then they're probably right and you're probably not. And at some point you're gonna have to listen to them. And no matter how much you kind of be like, take what you don't want, take what you don't want, take what you don't want, like they're not going to listen to you, and most likely you're just going to annoy them or piss them off or whatever. And so I think that's one of the things, and I think unfortunately some people, and usually I tend to see this more between more inexperienced founders, is I think because of their ego, they get really attached and try to think like, oh, I'm this genius and et cetera, et cetera, et cetera. But that's not, at the end of the day, it's not really the case. And also I think, if ultimately you should be trying to help somebody, and if your experiments and your tests are telling you that like either what you're doing isn't helping them or they don't want it or whatever, then that person's probably right, because their opinion on this is what matters. Your opinion of like, oh, you should want what I'm giving you, well, so what? Or what I do should help you, and they're telling you no, it doesn't help me. Well, so then I mean that's what it is, right? It's sort of I don't know if this is the exact place to put this, but it almost reminds me, Mike Tyson has this great quote, which is, everyone has a plan until they get punched in the face. Like the market is going to punch you in the face, and they're going to tell you what things really are, right? And you could sort of have your plan and whatever, but they're going to tell you how it really is. And yeah, I think honestly, for a lot of people's personal mental health, you have to take that not personally. Because they're saying that, this doesn't help them, doesn't mean that you can't help them or you're bad or whatever. It just means that essentially you're trying to solve the way that I look at it is most people are trying to solve a problem that's very complex, but they're trying to solve it by only seeing a significantly small percentage of the entire picture. And so basically when you're getting, let's say, negative feedback, the way that I would look at it is think about it as that means someone is trying to show you something that you don't see, and they have access to information that you don't have. and that's probably what's getting in your way. And so it's not necessarily like, oh, you're bad or this or that. It's like, no, it's just, you're seeing things through your perspective. Your perspective is limited. And I would say realistically, the more and more I learn, I think most people's perspective is probably no more than like 20% of what's going on at best. So if you're seeing your 20% of the picture, but the other people you talk to are seeing, different 20%, maybe there's overlap, maybe there's not. And their feedback is giving you insights to what the other 20% is. And if you can integrate that into what you're doing, then maybe you go from 20% to 22%, 25%, et cetera. And having the ability to expand like that is what's going to ultimately make it so that you can succeed.
Absolutely agree. Let me ask you, to get money, you must pitch. What can be a great pitch for you that convinces you?
The way that I see things is it's not necessarily about the pitch itself. And I think one of the biggest problems that most founders do, and I also sometimes do workshops on this, is I think they forget that at the end of the day, their company as a whole is a different form of a product. And in the same way that let's say you'd have to sell the actual product or service that you're offering, if you start to think of your company like a different product or service, just with a different market and a different consumer group and so on and so forth, customer base, I think it really changes the way that you approach pitching. And I think one of the biggest mistakes that I see from startups is, earlier in the conversation, I listed, the 5 areas of interest that I have and that I'm looking for. And I'll still often get pitched startups that aren't in those 5 areas. And that's very much like from the, almost before that, within the first sentence, it's almost an automatic no. Like it just sort of like, this doesn't meet my investment mandates. Like I can't really do anything here. You can pitch for your practice and some people will or will not be open to doing that for people. And I don't know, personal opinion is I'm fairly open to, look, just being honest of like, hey, if you want to pitch for me, but you're not going to get investment, but if you want it, you want the feedback, whatever, I'm happy to do it. I think it's just, my personality. Like I said, I used to be a teacher. So I'm willing to give back in that way. But at the same time, I get pitches all the time. And at some point, I think I updated my LinkedIn profile to be very, very specific of like, I'm only looking for these things. Because in general, like I'm seeing a ton of deals. It's usually, 1,500, 2,000 a year. If you're not relevant in the area, it's just a straight up no. And it's ultimately, depending on, unless you just want it for practice, realistically a waste of both of our times. And realistically, it could take, a 30-second, 1-minute Google search for most investors to figure out like, is this relevant or not? Is this a good match or not? So I think that's really the first thing. I think you can solve a lot of problems right there of just like, am I approaching the actual right person who is going to be open for the pitch I'm going to give them? And I think a different thing connected to that is that I think a lot of founders don't really understand, let's say, the numbers game of investment and how much is going into it. So like I said, right, I would say almost every full-time-ish professional investor is probably seeing somewhere between 1,500 and 2,000 investments a year. Realistically, they're going to make an investment in maybe 5 to 10 of them per year. Yep. Which means that if you're going to be one of those investors, like if you're going to be one of the companies that they actually invest in, you need to be like one of the top, 200, like 0.5% or something, if I just did my quick math correctly. So you need to be in the top 0.5% of what that investor sees, of everything they see. Now, like that might sound very, let's say, intimidating for a startup of like, oh, I need to be the top 0.5%. Like that's really, really high. However, the flip side of this is almost every investor, I would argue, has a slightly different investment criteria. So what it means to be in the top 0.5% for one investor is not the same as what it means to be in the top 0.5% of a different investor. And I think what can prepare you to be successful is to really think about like, who are the investors that I have the even potential for being in their top 0.5%? because if you're approaching investors where, like I said, it's not a good match for various reasons, or a different one could be, maybe it's a company in one of the 5 areas that I mentioned, but let's say they're a pre-seed company. That's still not really a good match. Maybe it's higher than something that's like outside the 5, but it's still like not a good match for the checks that we write. You're kind of dead on arrival. And I don't think a lot of the companies do this, for lack of a better term, homework in advance. Because I think if they do the homework, then actually everything starts to fall in line, because the more and more of the match there actually is, then the more and more you're pitching to someone who actually understands what you're doing. They actually care about what you're doing. They're actually incentivized to try to get what you're doing across the finish line. And when you have all those things working for you, then your pitches are much, much better. If you have those things working against you, then it's quite difficult. And then I think from there, just let's say, when I'm actually seeing the pitch itself, and echoing something a little bit say before, I really want to see this thesis of your startup like within the first 2 to 3 slides. And to some extent, I would argue that the thesis of your startup should be something that I'm going to like condense into essentially like 2 sentences. Should be something to this effect: we found this problem, we figured out a way to solve it. We found this problem for these people, we figured out a way to solve it. If we solve it for these people, they will pay us. Like that's pretty much like the core of just about every successful company is some, like, what problem you're solving, who you're solving it for, you actually solve the problem that you've found, and people are actually willing to pay you to solve that problem.
I agree.
And it's for me, it's amazing that again, I'm seeing 2,000 pitches a year. The number of companies that can't easily articulate those things is something I would argue probably in the like 80 to 85% range. That they have problems in some part of that, of articulating that kind of concise, 2 sentences. And it's obviously, when you present it, it's probably not going to be presented in 2 sentences, but I should have a sense of those things within the first 2 to 3 slides of every slide deck, I would argue. Of what is the problem, who has this problem, kind of what your solution is to this problem, and are people going to pay you for it? And if I get a sense that those things are kind of let's call it well thought out, then I can start to look at all the other stuff. But if those things aren't well thought out, then at least for me, I think a lot of the other stuff like essentially is based on faulty assumptions, like very faulty assumptions. And so it becomes, not to say I don't, and maybe in a rare instance, other stuff I see will change my mind. It's not a 100% perfect system. But that solves a lot of problems. Like I'd say that there's very, very few false negatives in this system. And for the most part, it weeds out a lot of companies that, for the most part, don't go anywhere.
I would like to close with a forecast for the future. Where do you see most of the money in venture capital moving in? Where, if I'm a founder, I should be more focused if I would really want to solve some problems?
All right, so I think you're asking like 2 very different questions. Well, let me answer kind of the second one first. I think makes more sense. To a certain extent, I don't actually believe, like, if you're a founder and you want to solve problems, I wouldn't necessarily think about like where's the money moving. I think that's a very, very bad way to think about these things. I would think much more about, what is the problems I really want to solve? Which are the ones that like keep me up at night? Which are the ones that I would do if no one would pay me? All of these things. That's what I would focus on. And I think for a lot of people, they might have trouble thinking, what those problems are. But interestingly enough, I mean, there's an abundance of problems out there. A really, really simple example is, the UN put out the 17 SDGs. minimum that's 17 high level problems. But if you look into the 70 SDGs, I think it's, I don't have it right in front of me, but I think it's 240-ish sub goals. So you basically have like 240 problems right there. And each one of them would need like an individual, if not maybe more than one company. So that's like hundreds, if not potentially thousands of business ideas in one document. So if you kind of like, what problem should I solve? Go through that document, go through the SDGs and go, which one really excites me? Go try to work on that. Learn what you can, become the expert, become like, we can be the number one person in this area. I think the other thing as well that I think people sometimes get caught up on is this, the fact that like, okay, well, I'm going to start working on this, but other people are, and what if they solve it first and whatever. But I think at the end of the day, there are, for one, two things. One, generally speaking, solving problems usually doesn't kind of finish things. It's not sort of like that got solved and everything is great and we don't have to think about that anymore. Usually solving one problem kind of opens up the next problem, right? It kind of becomes a new thing. I don't know, you could sort of think about something about, right? We used to go around with horses, and there was at one point in time where like the amount of horse poop in New York City was so bad, it was becoming like, people were like, how are we going to deal with all the horse poop in New York City? And then we got cars. And now we're at a point where we're like, man, like cars are so polluting and you know, increasing the CO2 levels in the atmosphere and is increasing the temperature in globe. Like, how are we going to deal with this and whatever? And it's just like, okay, well, we solved one problem, which was like a poop problem, but that created a different problem. It just sort of, these things are never ending. And I think it's ultimately almost a part of the human condition that we're going to be constantly, there's going to be constantly problems out there. Look at things like from like a, you know, hero's journeys perspective. We're going to constantly need to be a hero. There's going to constantly be dragons. There's going to be a never ending amount of dragons that we need to fight and overcome. So like, don't worry that like, oh, you know, whatever, what if someone had solved it first? Well, they solve it first and you move on to the next one. And yeah, I guess it's a little bit unfortunate that you spent whatever amount of time barking down an avenue that someone else solved first. But then if you really think about it, and if you really care about solving the problem, then you should just be happy that, oh, this problem got solved. And like, okay, how can I use my knowledge to work on the next one and the next one? I think that's why you often see, you know, a lot of really people who are truly, excuse me, entrepreneurs at heart. They keep building new companies. They look for the next thing to work on, the next thing to work on. It's part of their DNA. I think it's because they almost can't do anything else, right? They want to figure out different ways to make the world better. And I would say for all practical purposes, there's almost forever going to be an infinite number of ways to make the world better. There's going to be almost always be an infinite number of imperfections. There's almost going to be an infinite number of ways that you can make someone else's life easier. So, you know, like, don't worry, like just find something that interests you and run down it. So that's like that side of it from the founder's side. I think from the, let's say from the money side of things, the way that I often think about it, right, is I think money is chasing where they think the good opportunities are, which I think becomes, at least in my opinion, a proxy for what do we see as the most promising problems that need to be solved in whatever time frame. And you can argue about what that time frame is and so on and so forth. I think I would kind of argue you tend to see two kind of time frames working themselves kind of in parallel. You tend to see kind of a much more short-term time frame, which honestly ends up chasing hype cycles, you know, and I think right now, for the foreseeable future, you're probably going to see a generative AI in the next 2 to 3 years. I think you're going to get a hype cycle around funding around things like that in kind of the short term. But then you also see kind of a more longer term kind of investment theme. And I think right now, and you're seeing it, right? Probably, I would argue the two biggest areas you're seeing a kind of more longer term investment theme where, you know, there's going to be funding in these areas for quite some time is going to be in clean tech and environmental technology. Is you're going to see, you know, probably for the next 2-3 decades, strong capital in those areas. I don't think that's going away. Again, I think generative AI might be the next 2, 3, 4 years, but then you're probably going to see it dip down. You're going to see kind of similar to, let's say, what happened with potentially things like crypto blockchain, for example. We just saw that cycle kind of come and go, et cetera. I think you'll probably see something like that happen in generative AI. The other area that it's I'm a little bit biased because it's my background, but the other area that I think is quite interesting, and you'll start to see is things in biotech, life science. I think you're going to start to see, basically, you're going to start to see solutions coming out of that area spread into more and more of society. And because you're starting to see these types of things, there's going to be a lot more money going into these things, and that can be anything from new ways of doing drugs and medicine to the future of food. I've started to see things of what I like to call the cell as a factory. So how to produce like high value compounds from cellular biology. And I think over the next, again, I think kind of similar to climate tech, the next 2 to 3 decades, you're going to see pretty strong investment in these areas as they, again, I think it's connected to, as they're solving some problems that we strongly have in the world.
Alex, it's been an extraordinary time with you. Thank you so much for coming to the Investor Talk. And thank you so much for sharing with us and our founders your point of view and your knowledge. Thank you.
Perfect. No, Max, thank you so much. Happy to be here. Happy to do it again if you have other things you want the founders to learn. And again, thank you so much. This has been great.
My pleasure. Thank you.
Thank you.